My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey folks, welcome back. Today our special guest zooming in from Washington, D.C., John Rubino with JID Investments. And John and the gang, they work with a lot of real estate investors, and they are popular guys because they help provide capital for deals. So today we're going to take a look at what they're doing, what's going on, what they're seeing with the crazy market situations going on these days and how that's affected things. So John, welcome to the show.
Thanks for having me, Dave. I was looking forward to this, and I'm excited to be on with you and your listeners.
Well, I'm excited to have you as well. So John, give us a little zoom out, a little 30,000 foot perspective of JID Investments. What do you guys do? There's two sides to the business. There's lending money, there's raising money to be lent. So talk to us a little bit about the lending side first.
Sure. Well, the business really started on a concept of me being a passive investor for about 10 years. I was in the Navy for 20 years, and about halfway through my career, I started to invest passively in real estate through some friends that were raising money for projects. Sometime I'd say right before the '08 crisis and the recession, but that time cash was king, and I was in a position to be able to help these guys out and give them some capital for their deals. And so not only was I getting a great return on my investment, but I was also learning about pro formas and decks and analyzing deals and looking at markets and really understanding that process. And so for 10 years, I was doing that. And when I was getting ready to get out of the Navy, it was my last duty station here in D.C., I decided to take that concept and turn it into a business. And it's been very successful. We started out with private loans to borrowers, with fix and flips and renovation projects. We bring in about 80-90% of the money, joint venture structure, pretty straightforward. But then we got into our sweet spot, which has been raising capital for equity, typically around $1 million to $6 million for a single purpose vehicle or a specific asset that we know where our capital is going in with sponsor and location, timelines, returns. So it all lines up real well. We've grown our network of investors to about 200 to date. And over a 13-year span, we've raised capital for 33 projects, a little over $40 million, with about 13 or so still active. Most of those, I should say a good chunk of those before COVID. So we definitely have been on the COVID and inflation and supply chain roller coaster.
The roller coaster. Yeah.
Yes, sir. But we're getting through it pretty well, Dave. I think, the big thing there is just good communication. Making sure our investors know what's going on and that we've got a good plan even with these crazy times.
So what is your buy box, John? When you're looking at opportunities, what are you guys looking for, especially today, mid-2025, considering interest rates and struggles that some multifamily syndicators have been having recently?
Yeah, so the foundation's always been the sponsor, the business that needs the money. We have to make sure that we feel good about them, that we're a good fit for them, and that they bring value to us based on our parameters and what we're looking for. I would say pre-COVID, sometime between 2012 to 2019, you could pencil deals pretty well with leverage debt at around 75%. You can come in on deals that were relatively safe when it came to interest rates. But once COVID hit, that all changed. Now you're looking, as you probably know, your listeners know, 55 to 60% is pretty standard, maybe a little bit better on a value add deal for leverage debt. Interest rates are still very high from the environment we were in. Historically, they're still very low. So now it's just really a matter of making sure that we're partnering, again, with that foundational type sponsor that's experienced, has been through a few cycles, and that the deals now underwrite given the changes to the environment with COVID and what we've seen over the last couple of years with the interest rates.
So the deals that you're looking at these days, how do they differ from deals maybe 2, 3, 4 years ago, besides, debt to equity?
Yeah, so our sweet spot's always been ground up, new construction, developed land. We can come in to fund or raise capital for that in the very early stages, say pre-entitlement or zoned, going through development, and then basically being in a position to build. Previous to COVID, we were doing several condominium multifamily. We were doing townhomes, some stuff that was selling at the end, or in as things were being built, we were selling or pre-selling. Now it's been really shifted to for rent, apartment, multifamily, mixed use with some retail. We're getting into a little more value add, but we're also looking at like car washes or senior assisted living or student housing. So the diversity has definitely been on full display. And again, I go back to the basics. I always look at four things in a deal to see if it's even worth my time: sponsor, location, asset class, returns. Those are my big four. And if it hits my big four, then I'm going to dig in. But if it doesn't, it's not worth it. So I would say still really in the sweet spot of multifamily. As you know, several cities and markets have a need for affordable housing. So if the sponsor is good at what they do and they can walk that project through cradle to grave, let's say on a development all the way through to a finished product, we'll jump in and we'll make sure that it fits our buy box from returns and our comfort with that sponsor, that we know that we can pick up the phone and talk to the C-level executives. Because what I'm doing, Dave, is I'm taking my relationship with the sponsor and introducing that to the relationship with my investors. Yeah. So my investors want to make sure that I am very comfortable with these folks and I bring it to them when we start looking at their deals. And then I put my money where my mouth is. No total pun there. Well, I do bring in my own capital. I do invest in every deal, and I make sure my investors feel as good as I do about these companies.
So how do you structure it, John, so that that you guys are kind of pooling your money together and investing in these projects? Are you going in kind of as a group co-GP? Are you doing like a fund of funds? What does it typically look like? And if you don't mind, dumb it down for some of us that aren't super up to speed on all the acronyms.
No. That's fine. I'm not going to do that. I just explain it. You know, we go out and we pool our capital together, typically on one project from a sponsor, so that the funds that we're raising are going to come in typically as a limited partner, kind of in our own class membership in a deal where we're treated as part of or as a single member. And so for that member that's investing, let's say we're raising $6 million for a project where we're part of the LP or we are the LP, we will get a project level return at that level. And then that project level return will come back into our entity's private placement through our waterfall and our distribution schedule, so that it pays our investors returns from what we extract at the level at the project level. So our investors are typically making a return based off of, let's say, a hybrid total return of about 25 to 35% a year at the project level, where we sit inside of the deal. And then that money comes back in. And on a typical waterfall for us, our investors are making about a 12% preferred return. Now, if it's a development deal or if it's a new construction deal, obviously that's deferred and accruing. But as cash flow starts to come in and it starts to hit our level of the waterfall at the project level, so as we hit our portion of the capital stack or the returns that we start bringing money in, we catch folks back up on that 12% per year return, get them back their capital. And then usually we'll take a catch up to that 12% as a company to get some of that profit from what we've paid out, or we just go right into a profit split, which is usually 70-30 in favor of the investors. So at the end of the day, when the investors get their money back on a deal with us, they're usually making around 15 to 20% when you take into consideration the 12% preferred return and the profit split. And that's what we shoot for.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com. So these days, if you're focusing a lot more on build to rent type development deals, how does the exit plan work into that so that you guys are getting your investors paid out? Like if the developer is going to be holding on to it long term, is it through
Sure.
refinance? Is that typically what's happening, or how does it work?
Yeah, well, there's always going to be multiple exits, right? You've got your ideal exit, which could be an exit on a sale or a takeout at the back end, at the front end once it's finished. They sell the property, obviously higher a lower cap rate. Somebody comes in and buys the property, everybody exits. There may be some cash flow mixed up in there if we've got apartments that are leasing up. If we can get to that level to pay us some of those returns. If we're selling product, obviously, as condominiums or townhomes are being sold, you have the capital stack, so your debt's getting paid back first, and then if there's someone ahead of us that has a bigger chunk of equity in there, they're going to be in what's called a preferred position. They may be getting paid back before us, but the bulk of the funds on something like that will be paid either on the exit at the sale, or like you said, either a refinance, maybe a recapitalization of funds that come in for less risk for a lower
Mhm.
return, but take us out with our profits. So yeah, that's typically how we're seeing our exits, and that's how it's been typically and historically.
So moving ahead over the next 6 to 12 months, what are your goals for like volume of projects that you guys are ready, willing, and able to get involved in?
Yeah, so we've got a couple of legacy projects pre-COVID that we're seeing come to fruition and completion this year and early into next year, which is great.
Mhm.
We underwrote those deals as home runs, to use a baseball term, but some of them are finishing up as singles and doubles, which is fine. We're making money, hitting either the preferred return or getting over that a bit. But at the end of the day, I'd like to get a little bit more of that assembly line moving without that backlog. So that's priority number one. Priority number two is continuing to look at deals with our continuing and existing partners that we can help finance and fund, and bring money into. So, if you got a racehorse that's finishing first, second, or third for you, you want to continue to ride that horse.
Yeah.
And then looking at emerging partners, looking at new partners we can partner with. During COVID, I would say if we did one deal a year, that was probably what we did. But on a normal cycle, we're looking to do about 3 to 4 a year, where we can bring in, I would say, between, let's say, $10 to $20 million a year in projects, and keeping that cycle going through. And then obviously focusing on the investor side of the house, right? Making sure investors are comfortable and happy and getting the information they need, and then giving them the opportunity to, let's say, play with house money as they're making returns and profits, that they have the opportunity to bring that back in for a refresh.
So there's really two sides to the business, isn't there,
Mhm.
John? So you've got
Yeah,
the finding good sponsors and deals and doing all the underwrite and make sure the deal makes sense and fits in your buy box. Then you've got the capital raising side of things, the investor relations side of things. So let's
yes,
talk a little
sir.
bit about that. What you guys have got a couple of hundred investors over the last number of years. That's impressive, especially
Thank
starting
you.
from scratch kind of thing. I mean, just yourself and your own capital. What have you found best that works best for you guys over the years for attracting new investors besides word of mouth and referrals? That's I'm sure
Yeah.
that's number one, but what else
Yes,
works well for you
absolutely.
guys?
Number one. I think that if you can show folks that you've got the experience, that you can walk through your concept, you have great sound strategies based on foundations, and that you have a track record or proof of concept, that speaks magnitude. And then just marketing and getting ourselves out there through social media, and also trying to find different groups we can kind of network with. Folks that are
Mm,
out there that like what we do. But your number one point has been our bread and butter is just the organic relationships that we've built, friends and family who've introduced us to friends and family, and that just speaks hopefully to our reputation. But to be able to walk through the concept, the strategy, show folks how we put our deals together. Folks who join us as a new investor can become a new investor just by filling out an accredited investor questionnaire, and then they get to see the kitchen sink of how we do business. We're very transparent. We like to share our information. We take people out to project sites to walk, either with a hard hat and a vest, or when we have a groundbreaking or a ribbon cutting. It's a lot of fun. But I think at the end of the day, is we've grown as a business. We've been doing this for 13 years. We have a few full-time employees that are fantastic, but we're all part of a team. We're all kind of looking at the same goal. We want to do well. We want our investors to do well. We want our sponsors to do well. We also brought on Juniper Square about 5 years ago, and it's been a fantastic tool. So to be able to use that and have our investors be able to pull that out Saturday morning with their pajamas on and a cup of coffee, or on a Saturday night with a bourbon and a cigar to look at that is pretty neat. So I think we're evolving as a business, we're growing, but I like where we're at, and I have no real desire to want to scale and expand to be a mega $1 million business. I really enjoy what we do.
So I've spoken to quite a few syndicators and fund managers, capital raisers these days, and a lot of them are mentioning that there's some hesitancy in their investor base because of what's going on with the market. It's become a little bit more challenging. Some people are wanting to sit more on the sidelines, sit on their cash. Are you finding any challenges on that side these days, John?
Yeah, I think there's deals out there right now that folks are definitely very cautious with. I'd say opportunistic deals, which we really love. Folks are getting hesitant because of the volatility, but there is a ton of cash on the sidelines just waiting. And I think, politics aside, there's some things going on with legislation. If we see come to fruition, we could see some real excitement about getting back into the markets. We play in the opportunity zone world. We've got a few deals there. And so obviously we're very excited and anticipating hopefully this bill coming through Congress, because if that happens, that program can become permanent. And you can see a ton of money starting to flow into that, which is good news, right? Regentrification, affordability, you can start seeing some of those things. Politics aside, parties aside, I think that's just good for the country. But yeah, you're right. I think we've been in this very much of this fog or stagflation period. It has created opportunity. I will tell you, though, on deals where sponsors need to get creative, where we can come in and help refinance, recapitalize out some monies and take a priority position in the capital stack. So there's definitely excitement there. Some folks just, want to get their money back. So we get to collect the accrued returns and maybe interest over a 10 or 2 or 3 year period, coming in a priority to suck up a lot of that, deferred return. And that thing definitely makes things exciting. So yeah, creativity. But yeah, definitely, I definitely know folks are still very hesitant, but I think that the light on the horizon or at the end of the tunnel is getting brighter.
Good. So John, I think we were touching on this a little bit before we started recording that, you guys have got a ton of experience with ground up development type projects, but now you're also starting to look at some value add type projects. Maybe explain what that means to you. What does value add look like for you guys?
Yeah, I think typical value add is we come in, the sponsor comes in and really makes a change in the property management. You see some challenges with occupancy. Maybe we're not hitting market rate rents. We're at 80, 70% of market rate. So there's a need to make some changes, whether it's amenities or coming in and making some modifications to kitchens and stuff. So you're remodeling. So the value add piece is interesting, obviously from our perspective, because we're used to seeing deals with dirt or just, entitled land, but now there's actually a property there. There's a lot less risk, and we understand that. So the returns have to be adjusted to compensate. But at the end of the day, I think we understand that because we see it in the Class A format where it comes from new construction, it's fully finished, and then just understanding the operations, the management, and the execution. So we've got good background in that. It's just now taking it and starting it a little bit further in the process.
No, makes sense. Hey, John, well, this has been great. Thank you very much for sharing a little bit about what you guys are up to at JID Investments. If people would like to connect with you and find out more, where should they go?
Absolutely. So I'm on LinkedIn. You can come check this out. Me personally, John Rubino, or our company, JID Investments. I got the website there, my name. So feel free to reach out to us at jidinvestments.com. We're on Facebook. We're on social media. So feel free to reach out. We'd love to talk to you. And if you got a question or you have anything that I can help with, if you're looking at things as far as new deals or investing, I teach some classes as well locally, and I enjoy that. So feel free to reach out.
Awesome. John, thanks so much.
Thanks, Dave. Great talking to you.
All right, everybody, take care, and we will see you on the next one. Hey there. I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.